Good morning, everybody. Thanks very much for joining us here for this session, which is going to be focused on global real estate trends, opportunities, sectors, risks, returns. So quite a broad topic, and we're going to pick up some of the key trends that I guess are going to be driving the markets as we move forward. For those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media. We publish Real Asset Impact, Real Asset Insight, and also the EXPO Day, which is the English language news. So please do share any news stories. We will also pick up on some of the insights shared in this panel there. And thanks also to everybody joining on demand. This is one of a number of sessions that we've got here as a live program at EXPO Real. Let's start with introductions. Matt, maybe let's just start with you, kind of brief introduction of yourself and the company. Matt.
Matt Richardson, CEO of Income Analytics, relatively new prop tech business focused on pricing income defaults in real estate. 35 years in commercial property, most recently as the Director of Research at Fidelity.
Super. Georg.
Good morning, everyone. My name's Georg Gutfleisch. I'm an attorney at CMS in Vienna, in Austria. I'm focusing on corporate M&A and real estate transactions, and I'm particularly interested in working on renewable energy matters and ESG topics related to real estate. So I'm looking forward to the discussion.
Super. Eri.
Hi, Richard. Eri Mitsostergiou, World Research Director for Savills, a property advisory firm based in London and focusing on the megatrends that shape our industry.
Great.
Morning, everyone. Chris Nichols. I'm the portfolio manager at ICG for what is our strategic real estate fund series. We've got about 2.5 billion of assets under management. Elevating that to ICG, we've got about 80 billion euros worth of assets under management globally.
Great, thanks very much. Lots of topics that we can pick out, but we'll drill down and focus on some of those. But of course, if anybody's got something that they would like us to pick up on or share insights about, please do let us know. Matt, let's start with you. Just in terms of the trend, you mentioned there obviously that a long background in research, so you'll be very familiar with a lot of these topics. But I guess, what do you think's having a key influence on the market at the moment? And I guess what's going to have the most influence as well on European markets? And there's a lot of discussion at the moment around risk, obviously. So I guess, how are you seeing that from a real estate perspective as well? And I know that's a lot to fit into one question, but let's give it a shot.
I think what we need to be focused on at the moment are probably actually not real estate fundamentals. The things that are impacting us and are going to continue to impact us for the next couple of years are actually external factors, most noticeably interest rates. That's been the big change. Cost of capital and effectively asset deflation, not just in Europe but all over the world. And that's something that's going to unwind and take a little while to come through. That's had an impact obviously on liquidity, and that's having an impact on pricing, and I suspect we've got a little way to go yet on pricing adjustments as well, which I'm sure we'll come on to. So I think really, rather than necessarily focusing on sectors and markets at the moment, the biggest thing is watching the politicians and watching the central bankers, because that's where the decisions that are made there are the biggest ones that are going to impact us, I think, as an industry for the next few years. And it's, in a sense, this bull run we've had has been fabulous, but it was very much a financially engineered recovery, wasn't it, from GFC? We had a lot of free money. Everyone loves zero interest rates. We've had a great party. I think it's the hangover at the moment where we get back to something like real interest rate pricing. But I'll be interested to hear what the other guys think on that.
Yeah, and I'm going to set a rule right at the beginning, which is you don't need to ask, just come in on any topic. So if there's anything that anybody wants to pick up from what Matt has said, please do. Just come in. I'm going to give you a second now whilst I look at you to see whether anybody wants to.
I'll take that
Yeah.
second. So I would agree with everything that Matt has said. I think that the correction has come quickly, so you can, from an investment perspective, actually achieve yields which are, at least from a cash flow perspective, approaching or maybe even exceeding neutral. So impact of debt is challenging. I would drop down into asset class. And this is nothing really but a barroom theory, but with some credibility as well, which is, office is the asset class that people are kicking at the moment. Personally, I believe that we don't invest in offices, and we never have. It's not a new thing. Personally, I still think that there are pockets within the office sector that you can make money. My bigger concern is, particularly coming across from the Atlantic, that there is a contagion across other real estate classes that could in itself impact financing and therefore impact the markets from that perspective. So in an already constrained lending market, maybe a tighter lending market as a consequence.
Okay, good. And Eri, I just wanted to pick up with you. Obviously, your research program looks particularly at the global trends. So I suppose, how are you seeing that informing kind of decision making at the moment? What are some of the key things that you're looking at in your research, the kind of forward-looking ones where you're really thinking that's going to have an impact on the market?
Yeah. No, I agree with what has been mentioned already. Watch the politicians, watch the bankers. I would add to this, watch nature as well, watch society too, because these are going to impact long-term our real estate decisions, the asset types that we're going to choose, the cities that we're going to be in. It was a summer full of unpleasant surprises with hurricanes in Florida, with wildfires in Europe, with floods in New York. All these things impact real estate as well, impact people's lives, impact value of real estate, impact the cost of insurance, impact the cost of building, the cost of mitigating these risks. Cities have to be alert. So we need to watch, I suppose, which cities across the world, and Europe where we are also taking these things into account when they are planning the future growth of their future urban growth.
Okay, good. And we'll pick up on some of the sectors and those kinds of things shortly as well. Georg, just coming to you, you're obviously there from the legal side. What are you seeing as, I suppose, some of the trends, some of the regulatory aspects that are going to be driving the real estate side?
I think from where I'm coming as a corporate M&A real estate transaction lawyer with focus on renewable energy and ESG is definitely a trend in terms when I can pick up the financing and interest rates in the first step. The rise of green loans and sustainability-linked loans. With the EU taxonomy regulation, we have for the first time some definitive rules and definitions of what is considered green and sustainable. And this, of course, will also have impact on interest rates when getting external financing, because interest rates are what we see in financing agreements in the last couple of years, often bound to the match of certain ESG criteria. So if you match the criteria, you have low interest rates. If you fail on them or if you violate your ESG goals or reporting obligations, then the interest rates go up. And this, of course, also has influence on whether a project can be profitable or not and the return on investment. And the second point I want to address is insurance, because what we see with the increased complexity of regulation across Europe, is not only from a European perspective with regulations and directives, but also on a national level, is the increased amount of regulations companies and investors, developers and real estate operators need to comply with, always bear liability risks. So when it comes to insuring these risks with a D&O insurance, or when you have a transaction, W&I insurance, so this is increasingly important when structuring a deal or an investment in real estate. And these are the two major trends we currently see from a legal perspective in the market.
Go ahead, Matt.
I think it's a really good point, particularly the insurance point. But I think it points to a wider thing, which is, I think to now, the ESG piece has very much been E with a bit of S.
Yes.
I think what's coming through loud and clear now we're in a downturn is the G piece is becoming really important, which is the corporate governance and fundamentally transparency, because investors are pushing hard now to say, well, what is it we're exposed to? And I suspect we're all in this together. There's got to be a whole load more regulation and a whole load more paperwork coming our direction as a sector, which is probably no bad thing, but it does mean we've really got to start focusing on that G piece a lot more, I suspect.
Yeah. Can I just... I absolutely agree. So there is also one piece of legislation in the pipeline that will have a heavy impact on the G in ESG, and that is the Corporate Sustainability Due Diligence Directive, which is scheduled to be adopted, I think, beginning 2024, with a 2 years implementation period. So this will again increase liability issues, because apart from administrative fines and other penalties in case of non-compliance, there's also very clearly stated in the directive that there will be liability, direct liability of the managing directors and the companies, so a civil liability. And this is something that is not here now, and I think companies and every company in the real estate business needs to get prepared to that. And get their due diligence processes and systems in order, so to be ready when this enters into force. So,
okay, good. Interestingly, on the kind of broader side of insurance, I thought it was interesting to see in US states like California, it actually beginning to be very difficult to insure new homes full stop, because of elements like climate risk, which I'm sure we'll pick up a little bit. And I'm going to introduce Courtney Fingar in a moment as well, because there's an interesting crossover with some of the themes that are happening, both in terms of FDI, but also here, to pick up on a few points. But Chris, I just wanted to pick up with you on some of the key trends. You're obviously working across different sectors, but including logistics, which is a big topic at the moment in the industry, along with the living sector. So I guess, what are some of the trends driving with that, and how do you see that developing?
So I'd actually broaden it to beyond logistics, and in terms of themes that we invest into, it will be industrial and logistics, it will be societal infrastructure, so anything that is from digital infrastructure to education, and also groceries. So in terms of impact, and with an optimistic horizon, what do I think is going to benefit when we finally come out of the mire that we're in right now? Those assets which are relevant. The real estate industry has gone through and continues to go through a significant flux where we are seeing obsolescence in whole sectors. And actually we're departing ourselves from sectors and just thinking about relevance to properly functioning societies. And then if I draw back to talk about your question specifically, which is logistics, I think it's very important. You can now no longer say we are doing logistics. Look at the micro markets of where you're investing. That is really important. There was some discussion on the prior panel about big box, last mile logistics. I think there's a home for both. There's no doubt that the way regulation is moving throughout Europe, including the UK, that brownfield sites, urban logistics should benefit from a significant trend in terms of demand and consequently upward movements in rents. But there's also a home for big box logistics. But do your homework. Make sure that the investments that you're looking into are well located. Probably you need to consider at least as much as we have talked about in terms of ESG, in terms of your spend. Are you able, from an investment perspective, to hand over any of that spend to the tenant? We've just done that on an investment. So to summarize, in terms of logistics, I think what's going to impact, I think if you are in the right sectors from a logistics perspective, right locations, then you should benefit still from increased demand and rental growth. If you are in a windy location, watch out, because you'll struggle from a liquidity perspective.
Okay, good. And we'll pick up the sectors with you, Eri, as well. And also, I think there's an area around risks, and particularly income risks and the expectations, that we'll pick up with you, Matt. But I just wanted to hand over to co-moderator here as well, Courtney Fingar. Welcome. Do join us. And maybe we'll just pick up with the sectors first, perhaps with you, Eri, and then I'll hand over to you, Courtney.
I really like the point you made about the social relevance and impact of investments and buildings and sectors, and that's why we need to watch closely the social trends in every market and what is relevant to the community. And that's also linked very much to the demographics of each city. And that offers opportunities. It offers opportunities for diversification as well. And we see how many niche sectors have become more mainstream. They are small, so their size and liquidity maybe is seen as more limited. But we did an analysis and tried to make a projection on 13 global cities on how much space they will need in terms of some alternatives, namely student housing, data centers, and care homes. And the demographics are so compelling. We project that there's going to be needed 1.2 billion square meters of new space to satisfy the need for about 18 million new beds in care homes, 17 million of new beds in student housing, the need of the capacity for data centers from the growth of AI and the Internet of Things. So we're talking about a huge opportunity globally to enter, and these sectors can become very important for investors to choose from.
Great, Courtney.
Hi everyone. Thank you for letting me join a bit late, and apologies for that. I had a late running panel. So I'm Courtney Fingar. I'm a contributing editor for Real Asset Media working with Richard, and I'm the FDI lady. So I'm looking at the aspect of foreign direct investment, how it fits with real assets, and obviously FDI, so the typical corporate inbound investment impacts heavily on real estate because of the needs for industrial, commercial, and retail space, but then also the knock-on effect of housing because you need somewhere to put those workers. And what I'm curious from the panel is following on the discussion of sectors, so we can look at what are the hot FDI sectors and therefore how is that driving demand in terms of real estate. And forgive me if you spoke about this already, but I'm curious your view about EVs and gigafactories, because that's obviously the hottest of the hot FDI sectors right now and has big implications when a gigafactory comes to town in terms of industrial space and land and everything around it. How do you see that trend playing out, and do you feel an immediate impact of that in terms of real estate?
So why don't I take the EVs one, because I've found that really challenging, if I'm honest with you. So what you've seen in the UK, a big venture in the north of England for a massive EV plant that has failed. And we looked closely at that, and we just couldn't get comfortable with the risk-return perspective. We have gone through a process of seeing where these sites are being established, thinking that they will have a clear knock-on effect for all the reasons you talked about. All the feeders into those plants, all of the housing that comes, it makes absolute sense that it should drive income and there should be opportunity there. But candidly, we've just not been able to get particularly comfortable with that from a risk-return perspective. That may be our outlook, but others may differ.
Do the others share the kind of wariness about EVs?
I think you've got a difficult thing, because it loops back to something Eri was talking about, which is also, we were talking about the ESG. I mean, it's inexorably tied up with the access to renewable energy on scale, not least because you've got all of the other processing pieces that need to sit around it. I mean, the scale of these things I don't think it's a bit like the old days where you just dumped a car factory somewhere and you ship the parts in. It's a far more complex process because you're processing raw materials. You're invariably importing technologies from halfway around the world, and these things are on a vast scale, and they're big bets.
Yeah.
You're asking somebody to put down billions and billions on a bet. You better be pretty comfortable you've got it right.
And it is the availability of labor force as well, skilled labor force too, which is not there.
And in the example in the UK, the government basically hardly put their hands in their pockets. So if you on a big bet, as you put it, if the government is not willing to back it, that's not a good starting point. The rear view mirror test, if we'd have invested into that, they're headline points where someone would say, well, the government didn't put their money in, you put our money in, why did we? Now, it sounds like I'm being particularly negative on the sector. I'm not. The point you made is scale. The bet that you are making as an investor is the one that you're looking at, the one that's actually going to generate scale.
Exactly.
Because if they generate real scale, they are obviously immediately threats to any of the others that are growing up.
But the thing is, even in the US, that the government is backing up these initiatives. They still struggle to make it work because of the availability to energy, labor, raw materials, all this. We are our world has been working on a different model, the globalized model, and this trend now of deglobalization, it might take time to adjust, if ever.
You're quite right, because most governments now want this type of investment. It's very trendy to land a gigafactory, but actually the site selection criteria are very complicated, and the reality is that most places that want to land gigafactories simply will not. So it's very complicated. What does our lawyer think about that?
Maybe I think so from what we are seeing with our clients and in our daily practice is that EV gigafactories and EV production is, I think, only one part of the equation. I think the more important part, which should come first, is infrastructure. What we see in Austria is that EV infrastructure and energy grid investments, etc., are definitely a big trend, which also are backed by the government. So there are a lot of public subsidies and public funding available for this type of investment, not only on the big scale, but also on a small scale. So, for example, if you have an apartment building, there are some construction codes which require you to have a PV plant on the roof, and the grid needs to stomach this. So there must not only be EV production and renewable energy production, but also investments into the energy grid in order to cater for that. So and that's what we see also from a legal perspective, that there are more and more requests and transactions involving infrastructure investments, at least in Austria.
Which adds another point on the sectors, if you like, that we were talking earlier with Richard. I mean, is infrastructure going to emerge as a? I mean, it has never been like strictly a property sector, but are we going to see more property investors investing in infrastructure, because it is a sector that is required for everything else to work,
Sure.
But it has different pace in terms of returns and a longer period of waiting for these returns to come in. So that's something that I think it remains to be seen.
Infrastructure is an incredibly interesting point to raise, because there is that gap as well, again, with FDI, because the government entities that attract FDI don't usually have a remit to try to attract infrastructure investment, but they're wholly reliant on that for the attractiveness of their location, for their connectivity. So we're sort of stripping out often infrastructure investment, but it's actually central to everything.
But again, IRA in the US and then the Green Project in Europe, they are all pushing this direction to support it and help regulation and simplify regulation, speed up the processes, and even subsidize.
I think the two have always been interlinked, haven't they? I mean, asset prices are inextricably linked to infrastructure access. And if you actually look at the development model that a lot of countries have used in Southeast Asia, they've actually financed the development almost of whole cities like Hong Kong and Singapore on the basis of the metro systems and land sales, and have used that almost as a tax recycle to support the market. I mean, it's been right at the heart of what they've done. So it's, the two things are inextricably linked.
Yeah. The other basic challenge you've got right now is relative value. If you're able to secure good investments, and this is the climate for the best vintages across a number of different investing strategies, why would you take that risk?
I guess the other difficulty with infrastructure is it's so reliant often on the government strategy and funding.
Yeah.
I mean, we just see this in the UK, absolutely obsessed this week about HS2, and you have these huge government infrastructure plans that fall through. So how do we actually reduce the exposure? You know, because all the other aspects of investment, both FDI, real asset investment, just general capital flows, really need the infrastructure part to be right. But it's sometimes the most difficult part to get right. So how do we deal with that?
It kind of loops back to our first thing, wasn't it? Which is watch the politicians, not the property markets. It's everything that's going to drive the next 2 years is going to come out of parliamentary chamber or a central bank. It's those key decisions on interest rates, infrastructure and policy. And in a sense, our job is to react to that in the next couple of years.
The other FDI trend, and again, forgive me if you touched on this before I showed up, but nearshoring, reshoring, and all the shoring is reallocating a lot of global FDI activity, and therefore has a knock-on effect, clearly on logistics, but not only that. Some people claim that trend is a little bit overhyped, but actually real estate people tend to know whether it is or isn't, because it gets down to a fundamental issue of demand and where floor space is changing. I'm curious how all of you see that.
So it's definitely happening. I think it's definitely been overhyped at the same time. And I think it's very much a drip-fed impact into the markets. If we look at what's happening now in terms of industrial, it is super expensive to build, just the simple labor costs, the construction costs. But what is really stifling the occupational market is the fit-out costs, which can often be twice as much as the actual building itself. So nearshoring, onshoring can happen, but ultimately it's all part of a financial decision made by the corporates. And actually we are looking to try and unlock an opportunity by financing that fit out and to help make that happen. But it's been overhyped, it's a slow impact, and right now it's really challenging to make that work, I think.
Do you agree?
Yeah, I would say exactly the same, that what our agency in the market, that is, it's slow. It's happening, but very slowly indeed.
What do you guys think?
So,
I haven't really got much to add. It's definitely a trend. I mean, you see it, Iri, you touched on social trends. I mean, you do see it everywhere. People trying to localize little parts of their lives, what they buy, where they buy it from. But we also know how cost ineffective that is for certain goods and services. You're not suddenly going to start building your own EVs somewhere in a village. There's an undercurrent there, and I think from a political point of view, we do have to be aware that there's a lot more protectionism around. And one of the things that's caught the UK very hard, being outside the single market now, is market scale is going to be everything for any of these types of industries.
It might be interesting just to pick up briefly on, ESG, plainly a very big trend. We'll pick up in a little bit later in terms of how it's being seen differently in the US versus here, for example, and some interesting things would come from that. But I guess that also influences then risk to a certain extent, both in terms of income risk with older assets, transition risk in terms of assets beginning to move, and also climate risk, elements like that are beginning to be kind of more key topics for the industry generally, I think. So I guess, how do we see that developing? Do you think that's something where the industry will ultimately find a solution to that over the next 2, 3, 4 years? What's your sense of that?
So I'd actually love to be able to give you an answer to that, because I don't know is my real answer. And maybe to allow the rest of the panel to talk about the mainstream response to that, I'll just talk about something that we're having a challenge with at the moment. So we bought a sizable last mile logistics portfolio within Germany. We're knocking on a year to get that financed. Super good tenant, annuity style underlying incomes, delivery of pharmaceuticals to hospitals and chemists. From my perspective, I think it's a really good bet. The tenant constantly invests into its real estate. The banks, however, can't work out what the ESG exposure is. And this has completely handbraked the financing process in an illiquid financing market. So what I'm going to say to you is, in particular, I've sort of narrowed this down, is I don't know what the answer is. As you can probably tell, I've got a frustration with how that process is going. It's very difficult to quantify, and we're trying to structure around it at the moment. We will get finance on the deal, but until parts of the market, like banks, actually figure out what they're going to do, it's going to be quite costly and quite expensive, and it means that hold periods will go for longer, liquidity will be impacted. It's a real challenge to be able to quantify it as from an investment perspective.
I think George probably have some insights into this. What do you see with your clients in terms of the impact of ESG considerations on decision making, but more importantly, the financing piece that was just mentioned?
Yeah, I think when it comes to financing, we see an increasing importance of sustainability-linked aspects in financing agreements that also have an impact on interest rates. So interest rates vary on the quality of your sustainability and ESG aspirations and considerations. If you don't match that, financing is on the one hand harder to get in the first place. On the second hand, it's getting far more expensive. We also talk not only about interest rates, but for example, early repayment obligations or penalty payments. What occasionally comes into discussion when negotiating financing agreements that have a sustainable aspect, and this is getting more and more. And I think one must differentiate between the bank on the one hand, as you said, because the bank, it's quite difficult for a bank to know what they want, because they are confronted with ESG, say you need to give your financing to companies that meet ESG criteria, and the bank asks itself, what are those ESG criteria? So there's the first step here has been taken with the EU taxonomy to give some guidelines and terms to have some orientation. And the other aspect is how is the bank reviewing and scrutinizing the ESG compliance of their creditors, and there comes the creditor in place. So the company that needs financing, they will be confronted with a lot of new regulation in the coming years. So one we have already briefly touched is the Corporate Sustainability Due Diligence Directive, which goes back into the supply chain. For example, when developing a building, you don't only need to look at yourself and your own ESG compliance, but also the ESG compliance of your subcontractors and generally the companies you engage with the construction works. And the other aspect the company is confronted with is ESG reporting obligations. And there it's not so much on the reporting itself, but on collecting and gaining the data that go into the report. And there also needs to be some processes and structure in place that are not there yet, but need to be definitely implemented at some point. And this, of course, also requires financing and commitment, because you need to develop and implement the structures in order to comply, not to comply with your ESG obligations, but to report on them. So you need to collect data, you need to process the data, and then you can reliably generate reports on your ESG compliance. So there are a lot of challenges ahead that need to be figured out at some point. So.
But I think this is tremendously important, coming back to your governance point, because the next phase in this shape of the correction in pricing is going to come out of the banks, isn't it? It's not going to be driven by equity, it's going to be driven by debt. And if the banks cannot get comfortable with where we are as an industry and what they're exposed to, it could get very mucky very, very quickly. If they decide to withdraw their capital, then we could be looking at a very different thing 12 months from now. So it's very, very important that these governance issues get raised and that people respond to them in a timely manner. because transparency is going to be at the heart of all of this.
Yeah.
And governance from the top down as well, where again the regulations and measuring practices and criteria are, I suppose, common field for everybody and meaningful as well for everybody.
I guess we're getting close to wrapping up, are we? I don't want to cut us short. Are there other questions you feel we need to ask? I would like to ask them before we leave about their kind of outlook for the next year.
Yeah, I just wanted to pick up a little bit in terms of, I guess, what the occupier side was doing as well, because obviously that's fundamental then to the real estate discussion as well and the value discussion. So I just wanted to pick up on that, and also where we're seeing risks. Obviously, Matt, as well, you're looking at income risk especially. So maybe just, because I know you're focused a little bit as well on the occupier side, Eri, so maybe how you're seeing that in terms of how that might drive the fundamentals, and maybe just how we're seeing risk, whether or not there's, whether or not the economic downturn will then have some implication moving forward for both income risk, but also broader risk.
We're struggling to explain what is happening in the occupier, in the sense, I mean, the obvious one is the fact that you have a polarization in the market, with people obviously focusing on the best product in the market. So there is a bit of an anomaly, despite the uncertainty, despite the slowdown in investment activity, despite picking up on vacancy rates. You have like prime rents rising for the best buildings. You still have, if developers can build something new, it probably will be absorbed by the market very quickly, and at the same time, the secondary assets are they are finding more challenging. I think the big question here is what is cyclical and what is structural, and that's why I'm saying we are struggling to distinguish now, because we are at the point where there is a bit of a slowdown in the cycle. So certain indications of a slowdown in occupier demand could be explained by structural reasons, working from home in the offices, for example, or lack of good quality stock. But I think that when we have a bit more certainty about the economic outlook, we will have stronger return of occupier demand in the market, and that is gonna, it's important, because it will drive the financial viability of upgrading the stock, which needs to be upgraded for ESG purposes as well.
Great, and feel free to pick up on that, Matt, but also on that, what you're seeing from an occupier risk perspective in terms of the income side.
I mean, taking it all the way back, commercial real estate in any form is fundamentally about cash flow. It's people doing things in places. We've certainly seen a very big uptick. It's not a big surprise in insolvencies and failures. Everyone's seen that across Europe, and that's really not a massive surprise given we've come off the back of government support programs. Inflation is hugely damaging for people at the moment, because it isn't just a simple home inflation, it's cost inflation to people in their operating businesses, and that's causing a lot of pressure on the occupier market. And also, we've got very different business models. I mean, touching back onto the point you raised earlier about, Chris, with logistics, operational leases and how they work are very, very different, and how occupiers treat space is very, very different to traditional leases. The building is the business, and therefore you have to look at it in a very different way. So your underwriting is far more about the business model of a company, not just the market they're working in and their balance sheet. It's understanding what on earth they're doing, and actually trying to figure out what the back-to-back risks of what they're doing in that building. If they lose the contracts, the building services, what happens next? So it's a far more complex market. I take my hat off to you on the direct investment side, because those are tough decisions when you're doing it, and you really have to get into the micro, and I know you guys do. You go right down in there.
Yeah. So we are fully aware of the occupational challenges that are out there, and that's a key part of our underwriting. But just to move on from what Matt was saying, to our portfolio, really, we look at the critical assets within a business, and that's what we buy. And typically that comes with long-term lease obligations and being able to make sure that your tenants can pay the rent for that period. So we hope that we don't have to worry too much about knowing the occupational market. to date. We've had all of our rents paid all the way through COVID, and we've had no defaults. Our time will come at some point, but the portfolio is covered 20 times by EBITDA. So we feel like we do really understand our tenants and our tenant businesses. But just elevating it to touch on what we talked through on the nearshoring, there is demand out there, particularly for industrial. It's getting to the point where the analysis is being done on taking new buildings, and it's falling short at the overall cost. And it's only taking a solution, which is, for example, financing the fit out, that actually will get the wheels moving in the occupational market. A bit harder. They are moving, but certainly not as fast as they were 12, 18 months ago.
Okay, great. I'm going to draw a close to it here because I've gone sadly a minute over time, for which I apologise. But that means that you can all get to your next appointments on the hour, which I know is important. Just in terms of the session, we've got coming up creating and driving social value in cities. Super panel for that, just as was this one. So if you could say thank you to all of our panelists here and to Courtney as well. And thank you to everybody here. And thank you also to everybody who's been watching this on demand as part of our live program here at EXPO Real. Thanks very much, everybody, for joining us. Thank you.